G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. When I started this podcast, I used to introduce our guests as being best in breed. I didn't realize at some point we get kings of industry coming on here, and I'm super pumped for today's episode. Scott O'Neill, welcome onto the show, mate.
Good to be here, mate. Thanks for having me.
Thank you very much. If you live under a rock and you don't know who Scott O'Neill is, you probably need an uppercut. You've been around and you don't look it, mate, quite honestly. You don't look like you've been around the industry for this long. But Rethink Investing has just gone from strength to strength. You've been pretty open and transparent about your journey, your portfolio, which I think is admirable because to put yourself out there and talk about your portfolio can attract all sorts of opinions.
Definitely.
And quite polarizing. And I think where you've gone with your industry, in your industry, where you've gone with your business and your portfolio is everything you want to get through today. So, mate, thank you very much.
Sounds good, mate.
Cool. So, I mean, to go back a little bit, mate, I was really happy. You reached out, dropped a LinkedIn message, and it was off the back of the episode I did with Akhil Patel talking about the property cycle. And you kind of mentioned I don't listen to many property podcasts. I'm like, yeah, same. I don't want to be kind of like a copycat for everyone else. Not that they're competitors. I think we're all just trying to put really good information, really good content out there as well. But the last thing we want to do is listen to what we're talking about all day, right?
It becomes an echo chamber, doesn't it?
Absolutely.
But, no, I really enjoyed that podcast and talking about cycles, and it was just different from what a lot of the other property podcasts are, talking about their own businesses and their own angle, and they're the ones I listen to. So that's why I don't, like you, listen just to what everyone else is saying, because they all sound the same after a while. Everyone's just got a different twing or personality trait on it. But great podcast. Hence I wanted to reach out and say good job, and enjoyed it.
I really appreciate it. I think that says a lot about you as a person, mate. I think you and we were talking about this just before grabbing a coffee, just like skin in the game. Like you're still in the game. There's something admirable, when people build portfolios, but they still want to be part of the journey for a lot of other people. There's something more intrinsically motivating you to keep going, and there's so much about your journey that I want to unpack that people can get mountains of info from. To set the scene, and I think this is really, really pertinent for where you're going with, say, commercial, right? And this is data that's just come out from CoreLogic literally in the last few weeks. So the residential real estate market sits at $10.7 trillion. Super sits at $3.9 trillion. Stocks, Australian listed stocks, sits at $3.1 trillion. And then commercial real estate sits at $1.3 trillion. So you think of it, it's almost like 10% of the resi market is a space that you play in. But you've obviously carved out a niche here, helping people make extremely good decisions in the commercial space. The decision to move into commercial and not be residential, what drove you there?
It's a good question, and to start, that 10th is so true. But in that 10th, most of it is geared towards the institutional investors. So we really are in a niche within a niche, because there's not much commercial that is in reach for the everyday mum and dad investor. Which say under 10 mil. There's most of it 100 million plus. That's
which really skews that number, then, doesn't it?
Exactly, and that's why you don't hear many commercial buyers agents, because the stock out there is simply it's very easy to keep a track of every deal in the country with a small team. That's how niche it is. Like residential is suburbs, and there's thousands of options out there. There's a lot more deal flow, so the capacity for that industry to be larger is there. And that kind of brings me to the next point. Like I originally was a residential buyer's agent, 100%. Started in 2015. There weren't many around. There was probably like 20 or a couple of handfuls of them, and they're I guess they're the OGs in the industry. Most of them are still around, and then there's been an explosion of buyer's agents, and rightly so. It's a good service. I think why a vendor gets represented and a buyer doesn't didn't make much sense, and there's some good operators in the industry. There's some average ones as well, but the majority do the right thing, because you have to, because if you don't, social media and track record gets found out pretty quickly these days. So it's a great growing industry. It's been good to be a part of it, and the commercial side is still the forgotten one, and it's because it's so niche. There's no mass business there that can really get created like residential, and I guess it was around 2016. When I bought my first commercial asset in 2015, which is 5 years after my first house I bought. So I played around and bought a dozen or so houses first, did quite well out of it, but I reached a serviceability block in my portfolio. It was around the time, APRA was changing rules and stuff like that. So
go back to 2015, we're talking like the interest-only caps and...
Yeah. It was just getting harder and harder. And my mortgage broker at the time said, look, try commercial because you've got the equity. Because I was doing strata title jobs where I'd buy a unit block in regional Australia, 4 on 1 title, split it, create equity. And it was really good back then because there was margin in it. There's not so much margin now. But I was creating more equity every time I bought, and that was great. That's how I rapidly bought, 15 or so houses, and half of the unit blocks as well. And there was just, I felt like I was then I was stalled. I couldn't do anything else. So I guess I always had a business which was built off what I was doing personally in my portfolio. So I then got hooked into commercial because I found out the lending was easier. The yields were triple, like from a net basis. Like I bought a 9% net yielding asset when I was buying 5% gross yielding houses. Yeah. You take your costs out of that, you're really down to 3% net. 3 times 3, that's 9%. So triple the cash flow. So I was like, this one property is giving me more cash flow than, the last 6 or 7 other assets I had with debt on it. And I was like, what? Like, I'm done with that. That was the thought process, and then I created equity with the commercial, and I was like, oh, that myth of no growth, no upside, like that's definitely false. So I just went deep into it, like really deep. Just looking at thousands of properties and read all the books they had in the US. There wasn't much data or chat in Australia, which was a big problem, and that slowed my progress. There's a lot of good courses and books and stuff now, so it's a lot more accessible in Australia. But I remember we were doing about we were up to 50 odd properties per month in 2017 as a business. So we were quite big back then doing resi. And then I moved the business away from it at the cost of revenue. And I did that because I was getting a little bit jaded with buying just houses. It became a bit monotonous just because I was very hands-on and doing at least half those deals. Yeah. So I just decided something different, and commercial was working and no one wanted it. I remember showing industrial assets to people and they just said, I don't get it, So it was very slow, and we went from 50 to less than 10 properties per month type of thing. But many years has happened since then, and it's, now the commercial's, 90+% of what we do.
It's incredible. You said you bought your first commercial in 2015. Is it less than 10 years ago?
Yeah.
Has this thing exploded? Because when I look at them, you're fairly open with your portfolio. So it's not, I think when you talk about it, there's no ego. You're just saying, look, this is what it's worth because you made some decisions. So as it stands today, what's the portfolio value like?
It's probably like 89 mil,
Wow.
89. So it just grows on itself now. So I'm not actively buying as fast as I used to. I'm more sort of debt reduction type of side. I focus on the business more. That I'm getting a lot more enjoyment out of that. The portfolio is there, like in 10 years, might be worth 60, 70% more in value. So like it doesn't need to be fed anymore, but managing debt, working with the banks regularly to get the best deal. It's a process of managing as well. Like this is probably the main reason why I don't go buy another 20 or 30 mil, because I could with the the LVR is probably it's about 40%, 35-40%. So it's quite low. Yeah. And I haven't gone and bought more just because it's like we've got 68 tenants commercial as well. So it's quite hard dealing with them sometimes. Like we're dealing with a tough negotiation with Aldi, the supermarket, Chemist Warehouse, multiple supermarkets, medical centres. Like these are not just bump the rent up $50 and there you go. You've got to get lawyers involved. You've got to understand what they're doing in other parts of the country, because if a corporation is doing something, you've got to be careful not to blow a deal up because they'll leave, or maybe there's upside.
These are blue chip tenants that you've got, right?
Yeah. They're corporates and they really they do what they're going to do, but you still control the asset that they make revenue out of. So you've got to maximize your position, because every time you bump the rent up, say 10%, you create 10% equity. So pushing rents up is very important for the overall wealth picture. Yeah.
So if you look back, and there's a great saying, you connect the dots looking backwards on your journey. And that first property, I've heard you talk about that first property that you bought up north, wasn't it? And then that then led to a series of next decisions and taking more action. For example, do you look back at your journey and go, there's one real turning point in your journey where you go, this can really work, and it's become that inflection point that you reflect on?
Yeah, good question. Look, the first one, obviously, I'll quickly go through that. I was looking at houses in Sutherland in the Shire or a unit in Miranda. They were the same price because the unit was a bit more upmarket and all that, and the house was,
It's wild when you think about it now, isn't it?
Yeah, and I looked back, I don't know why, I was just looking at the valuation about a month ago, and like it says the current tenure on RP data, and it said 13 years and 6 months. So I felt really old seeing that. And I was like, well, I've had that snuck up, because in my head it was always a 10-year ago scenario, but 13.6 years now. So, and the value was about $500,000 difference compared. Actually, no, it was about 600,000 difference than the unit I would have bought. So, one choice, that's 2 or 3 deposits on smaller similar assets. So, big win there, and the cash flow was higher because a duplex essentially, dual house and granny flat. But that meant more servicing, more capital growth. Like, so your first property, you got to get right. If I bought the unit, I'd probably have half of what I did, because all the money was from recycling equity, and I was an engineer on a modest 6-figure income. Like, that doesn't go far these days. So it's not like I was getting paid huge bucks, but the equity was the game changer. So if I didn't have that, I'd have 5 or 6 less houses, and then that's 5 or 6 houses less growing over a 10-year period in a bull market. Makes a big difference, that. But the real big different one, which is probably a little bit more entrepreneurial, was a unit block in Port Macquarie. This was my second unit block at the time, 5-on-1 title, and they listed it for 720 grand. And I just calculated what 5 2-bedroom units were selling for at the time, and it was worth about $2 million. You know, so I was like, why is it listed at this ridiculous low price? I just like did the math. I'm like, all right, I've got to buy this house, but I didn't have the money for it. So I quickly scrounged up every little bit of equity I had in the other houses and negotiated a long settlement. And then I got a Westpac line of credit, basically a credit card debt to do the rest of the deposit.
They used to offer those like 70K revolving, something like
horrible interest rate. And it was literally like, you know, it bothered me daily because I was calculating the daily rate. I'm going, oh, that's another, you know, my day wage gone, paying that debt, that type of thing. And but like just buying that, taking that risk, I don't think many people would have done that. Like, it was definitely too hard basket, but that freed up a lot of equity. It didn't get the full valuation I wanted, but I think I coughed out another 500-600 grand, which is almost what I paid for the property for future purchases. So that's kind of how I got places quick. It wasn't just sitting, just waiting for growth. There was value adds in there as well. But the cash flow was always quite high, which meant the serviceability was always there. And that was one of the key questions I asked the broker. I was like, can I service the next loan after this? Because it was my business. I didn't want to be an engineer forever. So I had to replace income, and that was the vehicle of choice.
Yeah, right. I mean, you're faced with, in your 20-something, the prospect of a unit in Miranda or a house in Sutherland, and you'd say like most 20-something-year-olds now aren't faced with that decision. They're effectively buying units, and that then limits their ability, to scale, because they're compromising on what type of asset they can buy. If someone's in that scenario, 20-something, and they're, you see it all the time, they're earning good incomes, particularly in Sydney and Melbourne, Brisbane. What advice have you got for them?
Well, it doesn't have to be Sydney or Melbourne, and like you'd be aware of this too, but you just look at the long-term 30-year growth patterns of Hobart, Perth, Adelaide, Brisbane. They're all growing at, call it 6-7% per annum. They're all at different points of the cycle, mind you.
Yeah.
Everyone's got this kind of big bias towards, they think Sydney grows more. And I get it. If you buy a $5 million property and it goes to $6 million, that's $1 million. Sounds huge, It's still 20%. It's the same as a 500 grand property going to 600. 20%. It's the percentage which is important. So I would just say, look, forget targeting markets you can't afford. Go to the cheaper capital cities. plan to hold long term. Try pick the cycle if you can. Like, don't go into a market if it's grown 80% in the last 3-4 years. Like, you've probably missed the boat there, because then the affordability is not there. There's probably profit margins for developers to then produce more stock. Then more supply will hit the market. Like, go into the markets which are due for growth, and that's kind of one of the how we still do investing for residential. That's my mantra: go where the value is. It's like that's what Warren Buffett does with stocks. That's what we do with property. You know, is the replacement value less than what it would cost to build? That's a great metric, because that shows value. If the cash flow is higher than you're getting for other parts, then it shows the yields there for investors. That should, over time, push more investors towards that product.
Yeah.
There's just little indicators there. They're very simple. You don't need to get too technical with quoting all the thousands of different stats, because that's a rabbit hole. And yeah, I think be a borderless investor is the advice.
Yeah.
There's always somewhere you can afford, and otherwise keep saving, do it next year.
That borderless investing part can be a real mindset shift for a lot of people, particularly in the capital cities on the eastern seaboard, where like parents are saying go and buy, and I think that's probably a big part of the equation I want to have a chat to you about, which is who's in someone's ear, because you've got parents, friends, family, everyone's got an opinion. What they say, opinions a bit like assholes, everyone's got one.
Yeah.
And so you've got this trusted circle of people, friends and family, that have been there, that maybe the parents haven't bought investment properties, but why would you go and buy in WA, for example, horror stories? And then you've got the team, and you've got, say, your mortgage broker, buyer's agent, financial planner, accountant, for example, who are then giving like maybe 4 or 5 sets of conflicting opinion about what to buy, where to buy, how to buy it, and in which entity and structure, for example. How do you then marry that together? Because you would have had this at some point when you're trusting your broker. What you're saying is you're capped out with serviceability, and some people go, right, I need a new mortgage broker. In fact, you said, I'm going to take their advice and move into commercial. So there's a certain element of trust that you've built with your team. How do you get that to kind of cover the noise that's coming, say, from the trusted circle?
Yeah, look, it's a tough one. Like, it's easier said than done. Just go, you've outgrown your current guys, move. So you always take into account what they say, but your journey better than everyone. Like, the responsibility is on you. Like, no one's going to get you 20 properties. Like, you need your own mindset. You're the one that has that random goal, So there's ways to get it. And when you reach roadblocks, your current guys start holding you back, that's when you need to move on. Because there's always a bigger fish or someone who plays with a different level or type of client. And that's what I found. There's mortgage brokers, if they don't have that larger mindset, can hold you back. Maybe they don't get the overall plan. So having someone that sometimes has done what you want to do is a really key part of following. So, that's what I looked at. Like, I wanted to follow people that were in places that weren't where the average person was, because I didn't want the average result. And I found that the residential, one of the other reasons I kind of left residential is I saw at the time there were other people building sort of large property portfolios of, say, 50 plus houses. I just didn't want that. I had enough. Like, there was a guy I followed back pre-GFC actually, and he had about 200 properties in Logan, just quite literally bought out everything. This is back in the days when there was, you could just get a valuation, a desktop, refinance. Like, it was creating a house of cards essentially. You could just get debt, recycle it, buy it. Like, you could keep buying as long as you could play with those desktop valuations.
Absolutely.
Then the GFC hit, and I saw him go from 200 odd properties to around 30, 40.
Wow.
And I thought, that's what happens when you play the game too hard, where you're not actually creating real value. You're just playing a leveraging game. And I just knew that was the wrong strategy for me forever, because it's not how you would run a business. Or maybe a tech business where they don't have profits. So I don't like that type of business. I like cash flow businesses, because for me that's real money, and that's how I wanted to run my portfolio. So I then left my old mortgage broker. I had a really good one at Aussie Home Loans back in the day. They were great. Like, one of the reasons I bought a lot of houses was from them. But as soon as I kind of floated the commercial idea past, because I wanted more cash flow, deer in headlights. Like, don't do that. We can get more serviceability through resi. And I just knew I needed a different person. I needed a different accountant as well. Had a good one, but then needed one that had more of a business mindset. So I went sort of more a larger scale, kind of accountant, and just moved until it took me till now almost 13, 14 years to find the right team, and they're the perfect team for now, and I hope they're the perfect team forever. But if not, there's always another advisor you can welcome to the circle.
Yeah, no. Again, you built this portfolio of resi properties, financially free by like 28. What's the definition then of financial freedom at that stage for you?
Well, for me, it was replacing my income and about half of my wife's income at the time. So we made a good dent into hers, and so the first goal was to replace her income, because I moved to Port Macquarie so I could chase my career. And there was two parts to it. One, it was part of the career journey. It was an area manager role. I was 24 at the time and had 150 people working under me. So it was a really, I was very lucky to be in that role, I thought. So I traveled.
Lucky, but you also got some real skill sets that they saw value in, like a young head on shoulders, but can manage a larger team. You're probably destined for like a corporate career at that point, right? And
it was super challenging because being a young person in management, especially the average age of the workforce in that area was late 50s. Yeah, right. And they're truck drivers, they're people operating mine equipment, there's the concrete batch operators, technically a rough crowd. And I'm just some guy out of Sydney with a uni degree, and it was very tough. But I enjoyed the challenge, but it was more tough on the wife because I pulled her out of a job she loved in Sydney. Effectively, her career was put on hold for this. So, goal one was just sort that out. It's very hard to get a job in Port Macquarie at the time, and she ended up landing a job in the council and super political and all that kind of stuff. And it's funny, well, not funny, but we had a council sticker on a car, and her car would get keyed all the time because they hated people working in the council, which I get. Just things like that were always in the background. And so that was a goal. So get her out of a role, but she would always work, just something she could choose to work in. But it went well because those unit blocks were pumping out the cash. The interest rate was lower at the time. Rents were growing quick. So it was the equation was getting more favourable by the month almost. So that's why we were trying to fast track things and replace my income a few years later, and that's when we quit our jobs. I remember calling the boss, and he said, "Where are you going?" I'm like, "Nowhere. Just got a property thing on the side." Or no, I can't remember what I said. It was literally I just been investing in the side and so disinterested in it. I think he was a bit pissed that I was leaving because they were half paying for my MBA as well, because it was part of the fast track to go to that next level in the career. And so I left half. I didn't fulfill my duties to them, and I get it. But we went to Europe for 6 months, and that's we spent less than we were earning from the property. So it felt like that was when we made it from that point. Yeah.
Now, has that obviously income's replaced? You're well and truly set up, beautiful family home. What's financial freedom look like now? Because people listening to this going, this is insane. I get an $85 million property portfolio, the business going great guns. Why?
Look, it's a good question. Like I was saying when we had the coffee before, there's, why do you then push growth? And I think, I never even thought about it until you asked me. But I think because I've had time off work where, we go to Europe for 3-4 months every year. We've got a house in Greece because the wife's half Greek. Her dad lives there, so we've got no family in Sydney. So going there is important. And when we're there, I can feel like I switch off. I'm still doing emails. It's like you. If you once you're a business owner, it's a curse. It chases you forever. But
that laptop comes with you everywhere you go, doesn't it?
Yeah, and it's always in the back of your mind. Even when and especially in Greece, because the time zone's the worst case time zone. Literally, you'll go to bed when the emails start coming through. So you don't want to stay up too late and then look at the email, because then you'll see 10 action items, and then the morning, you wake up, you're wondering what bombs are about to blow up, or what big ticket items you got to deal with. So it's always 8 hours of the day is going to hit you straight up in the morning. So, but look, you switch off during the day, and I think that allows me to know what it is like to do nothing. And we did the 6 months, 2016. or, you know, like I was sort of working at the time, but like it wasn't a real true business, to be honest, at the time. It was a hobby.
Yeah. Okay.
And then, yeah, we basically then, I guess I've seen what it is to not progress as well. And that's, so financial freedom now, to answer your question, it's just, I've got the option to work or not. It's not, it's just doing what we want. And what I want to do is just kind of progress in life. Like, I think that's the definition of happiness, enjoying the journey. The destination is not the happy part. Like, you know, I've never been someone who goes, buys a Lamborghini and shows it all off. Like, that doesn't excite me.
Yeah, it strikes me because I'm like, see, look, I don't see the bloody Gucci belts and things like that. And
Yeah.
there's something that's, I don't know, elevated in your way of thinking.
There's something like, I don't know what it's called. Like, it's a stable datum. They say whatever you buy becomes your norm. You know, like, I don't know, if you've ever bought something nice, that becomes your average stable datum point. So you buy that new house, it's, you know, it's going to feel lovely and great for a while, but the excitement shines off, and then it's just a house. You do notice it when you go back the other way and go, oh, I used to live there. And, you know, so you kind of need more to feel that same rush. So that's why people buy fancy things, to get that rush. But for me, it's more, you know, I get a lot of enjoyment with building the business and hiring good people. One thing I've really seen more importance is time, because I've been very hands-on with the business, and so that's why we're in a bit of a scaling stage now to kind of get, you know, the ability so I can kind of work on important things more than the really granular stuff, because then you can kind of influence more people, and that's a process too. So yeah, I don't know exactly what the definition of wealth is, but it's almost not thinking about the wealth. I haven't thought about how much I need for a long time, and it's more about what I want to do, and that's, yeah, it's nothing about revenue.
I love it. It's refreshing. It's really refreshing. So I think, and you probably see it in plenty of industries, the vanity metrics really start to come out. The portfolio's worth X, for example. The car is this, the house is this, and that's cool. But yeah, I think when there's a bigger game being played, you probably see that as well. Does your wife have a big role to play in this, in keeping you somewhat grounded, or family?
She's way more grounded than me, like to the point where it's almost frustrating. So, and I'll explain why. Like, I remember, I don't know, you buy the house and you go, and it's almost like she didn't care, because like, and she always said, I'd rather just live in a little shack as long as we're happy. Like, she grew up on an island with 30,000 people in Greece. So, and when you go back there, like, where, you know, you're driving cars that the doors don't close properly and the brakes are shot, like, it's really old school. And Greeks aren't as, you know, showy, like, especially on the islands. Like, you know, the rich people, there's not that many rich people there, but you would never know, because they're wearing the same shirt from 30 years ago. Like, it's that old school kind of hide wealth scenario there. I'm in an industry where you have to talk about wealth. Like, if I said once, you know, I remember my parents didn't even know I bought 6 or 7 houses extra, because I wouldn't talk to anyone about it. It was almost not an embarrassment thing, but they would question it. They'd wonder, you know, you just didn't want to go down that conversational route. But then when the buyer's agency started, it was the only way to be taken as a credible human on the other side. So, you know, you have to start talking, and then, being in newspapers. And then that was probably the most uncomfortable part of the journey.
Oh, that's what I
when
mean,
a
like
news.com article.
Yeah, I've seen those.
Yeah, and they're very clickbaity. And like, and you feel very exposed, and then like everyone just knows exactly what you own. And yet, but like the positive thing was, then people would want help, and then the business grew off the back of those kind of viral articles. And that's, I try to keep them to like one a year, because they, you know, there's lots of requests for those articles, because it sells their papers, you know, and they're backed by, you know, what is it? News.com is financed by realestate.com, and Sydney Morning Herald has Domain. So they need their property section humming in the background, because that's a big part of their revenue source.
And this is a great story when you have tens of millions of dollars of real estate, and like, no one's heart's going to bleed for you, mate. That's for sure, isn't it? Yeah.
No.
Getting on the same page as a couple, and you know, you probably deal with it. I mean, we deal with it a lot, where maybe one partner is a bit more bullish than the other, one maybe more risk adverse, and they're trying to build a financial house effectively are two different blueprints, and it becomes not a sticking point, but how do we come to an agreement that we need to take some action, we need to make some decisions without risking what they've built as well.
Yeah.
So how did yourself, it's Mina, isn't it, your wife? Yeah. How did yourself and Mina get on the same page financially?
Good question. It was sort of day one. Like, I remember like when we bought that first house, it was pretty ugly looking. It was literally fibro on a highway. And I took her there. This was, I'd known her for only a year or so. So it was a property under my name, my finances. And I just said, what do you think? Because I chose that over the Miranda unit, which was quite nice. It had views and stuff, and we were going to live in that. And she said, what does it return? And that was a bit of a moment, because I was like, well, I can tell you it was 11,200 positive per year. And that was interesting because it allowed us to then travel, because that's about what we were spending on a Europe trip. So it was a paid Europe trip back then to do what we wanted for like a few weeks. So she understood the benefits of cash flow, and that was a difference, because freedom was important, having the ability to travel for long periods instead of just getting that 4-week block that we're lucky to get with an employee. We now had longer than that. So in between jobs, we were traveling even longer. So I'd time leaving a job potentially around a trip and do an 8-week trip because we could. There was a bit more cash flow to play. The buffers were there. And so I think time was always more important than luxury items. Instead of just going into the nice house to start it, we went investing. And I don't know the exact number, but from memory, it was 19 houses before we bought a family home.
Wow.
So and there was commercial in that too. So we did a lot before we went into the owner rock.
Did that eat away at you? I mean, buying investment properties and not having your own home? Because I feel like some people, I'll speak from personal experience, I'm like, at our second, I was like, then we got served with like this notice to leave. I was like, right, never again will I be under the thumb of a landlord. And that was that turning point to go and buy a home. But did it, or it was, and I'll get to another question in a second, was it always part of the plan at some point, or did you just go, right, we need our own home?
No, I was always against the home because I knew I only wanted to do it once. So I was never financially in the position to buy what I wanted. And I just never saw the logic of buying a 2-bedroom unit, sell that, pay agent fees, pay stamp duty again, and then go a 3-bedroom townhouse. And then as the family grow, all right, we need the 4-bedroom house. It was 4-bedroom house or nothing. Okay. And because I didn't want to trade up because that's what everyone does. You know, their wealth builds as they get into their 30s and 40s, and then their house goes with it, and they sell every 5 to 10 years as a result. So I thought that was just inefficient. I'd go, well, I'll invest, and then wait until I could do the bigger long-term house. And the forever home was always part of the plan, and that was going to come whenever it came.
Yeah, nice. You talk about intergenerational wealth. So do we a lot. And when you think back to one generation where Mina grew up, and what your, where you started as well, and within one generation, you've completely changed the financial trajectory of your family. 2 very, very small kids.
Yeah.
And I feel like the next generation, that disparity is just going to get bigger between the haves and have-nots in property.
Yeah.
So intergenerational wealth through property within one key generation has just gone to a new level. Where do you look at the future in like property and when the people that aren't buying are going to get so far left behind? How do you then say, mate, you've got to be part of this market because it's happening with or without you?
No, it's a good question. And I've seen, I follow a lot of other economies because, especially we spend so much time in Europe, and I've seen what happens in mature economies. Like we're still an emerging market, and that's why Australia's so attractive. All of Asia wants to live here, all the European, it's a desirable, high growth, safe haven viewed, place. So you get your money into a property here, long term, you're fine. I've seen what that happens in other markets where it goes the other way. I'll use Greece as an example. The average wage a young person gets there will never allow them to buy a house. Bank lending is really hard there. There's house prices are still randomly high, but all the older people own everything. Australia's still got an opportunity to get in. It's getting harder, and it will keep getting harder to the point where what you said is kind of the majority of cases where you won't get in. That's just a harsh
Like the
reality.
New York market, right?
Yeah. And there's probably plenty of other markets we'd never think about, which is like that. Like there's just the older people own it all, and then the younger don't have no chance. And at least we can have careers, and you can study away, or build a business. You can make income if you've got your wits about you, and then yes, you can then buy houses in other parts of the country. It's definitely possible. It's getting harder though, and it will keep getting harder because cost of building is going to keep going up. Immigration will always be a lever governments play to get votes to boost the economy. Like it's going to be part of reality, whether we like it or not. Both sides of the government. There'll be periods where they slow it down, speed it up, but the net position over the decades to come is more people here, and it'll get harder and harder. So you just got to get in, and then you will be one of the haves, and those who complain and do the other sides will be the have-nots. But I do feel for them. Like I'm here for one good reason is I got in at a good time. 2010 after the GFC, it's been a 14-year bull market since then. There's been a few sort of hiccups on the way, but time fixes everything in property, and that's my advice to anyone else. Like just get in. It is expensive now, but you've seen those articles saying the average house price in Sydney by year, whatever it is going to be $3 million. Like, it's mathematically going to happen, whether we like to, admit it or not. Like money is devaluing against property. So get in if you can by any measure. Just look outside your backyard.
The investor mindset. So that's, you talk about the home buying mindset. You're like, buy what you can, when you can, get into the market, buy quality assets, for example. That is time-tested advice that will never go out of fashion and never get old. Where do you see the wheels fall off for the investors? And I'll give you a few examples here, I guess, purely from a lending perspective. The attachment to credit cards, for example, the car leases, lifestyle creep plays a big part in that as well. Yep. A lack of even financial literacy about what's coming in and what's going out on all sorts of scales of incomes as well. Chasing shiny objects. And what I mean by that is the investment plan at the start has then veered, detoured, and they've heard someone here on a podcast or they've enrolled in a course here. So when you hear all that and you're like, here you are as, call it the finished product, for example, how does someone stay the course and not get pulled in so many financial directions as well?
Yeah. And it's a good point. Like the lifestyle creep is something people don't talk about enough. Like, because I see with a lot of my high net worth clients and, medical professionals.
And I think I go to scale because someone going from 80 to 100, 110, 20K in corporate, the shirts aren't from Oxford anymore. They're from MJ Bale, for example, or the watch isn't long jeans anymore. It's IWC, for example. And they've effectively spent that pay rise. And then you go to the next bracket of, say, 200 to 500. It's like the holidays aren't to Bali anymore. They're to the Maldives. And the hotels are 5-star and the cars are all European on leases. And then you go to your high net worth clients and that's just an uber different level of wealth, right? So you keep going.
Yeah, no, it's 100% right. And that's all after tax money too. So, there's the education for their kids and stuff like that. So you could be a specialist medical professional on, 7 figures. Doesn't matter that, you'll lose a big portion of that with tax and then a couple of cars on a lease. But you lose most of your money buying your PPOR, your house. Because no matter how much you earn, there's always a house in Sydney or Melbourne you can spend all of your money. And that's what the trap is that most people fall down. Like especially, in the my age groups in the mid-30s, there's a lot of people who are getting the real big pressure to buy the family home. And like I'm from Sydney, so eastern suburbs, you need to spend 3-4 million to get a freestanding house, and that's in the cheaper parts of the east. You can definitely go multiple times more than that. Doesn't matter what you earn. Once you buy that mortgage is going to basically be a boat anchor on your investment journey forever. So the plan's out the window at that point. But I get it. The pressure's there. Like you don't want the mortgage, I had to move, I couldn't even tell you, but I've moved a dozen times in the last 10 years and it's, it gets to you. Like, your furniture gets ruined. You got to, you lose 2 or 3 days of your life unpacking and like it's a pain. And then, there's different types of landlords. So I totally get it. It's not for everyone, but it was very hard to stay the course personally, even for someone like me that I could map out things, to my 50s in my head from where we wanted to go. But yeah, like there was always like, that's a good deal because you're going to look at the suburb you want to live in. And at some point you'll be able to, if you're lucky, be able to afford it. And that's the moment where you get tested. And if you go down that route, your plan's done. But we delayed it at least 5 years more than we wanted to. And it made a big difference. It meant we acquired assets that we never would have bought after the house was bought.
Yeah, okay. Yeah, I mean, people hate when you say delayed gratification, but this is effectively what it is, where staying the course becomes the extremely hard part. When the incomes go up, it's like now you can actually cash it in and buy the family home, but at what point do you do that? Yeah. I feel like we play real life Monopoly is what I call it when you start buying property. You got all the different, you go buy the cheapies, for example, and you go either blue chips, or the blue and the red, and the green properties, for example. And then I see a lot of people just going round and round collecting their $200 as you pass go, which is effectively their paycheck. Going around and collecting your $200 and trying to save up, pay off your mortgage, for example, have a few weeks holidays here. I don't feel like it's the formula that works anymore. No. There's very little left over at some point for families to proactively save. I think I worked it out. The average savings account across Australia is 37 grand. Now that's average. So those people have more and those people have far less and their ability to save. So when prices increase on average nationally around, call it $1,500 a week, median house price growth per week, and people are saving on average $300 a week, it's very, very clear that you cannot keep up with the property market as well. Yeah. So when you hear that, what advice or what guidance can you give to people? Say, how do you break this cycle of going, this is not working? Work hard, save, because you've been in a six-figure career, MBA, you almost saw that corporate career laid out for you going, I'm going to be to this level, general manager at this level, on path to CFO at this or CEO at this level. And at some point you broke this just going, this career, it's not stacked up. It's not stacking up for me.
Yeah. And look, that was my way of staying ahead. I thought just chasing promotions and, I guess that was the initial goal. So yeah, I was very focused on getting out of where I wanted. So, it's funny we talk about how money's not as important. It's very rich me saying that now because it wasn't the case. Like we were incredibly frugal. Like I traveled a lot in my younger years, but I worked when I was overseas. Like I worked in Canada as chef. Like I just didn't want to come back in a negative position. So I'd work extra hours to make, things like that viable, I guess. But yeah, no, we definitely saw there was just we were falling behind otherwise. So yeah, we just basically wanted to chase career promotions and then we worked together as a couple to set a plan to save as much as possible. And take jobs that pay you a little bit extra, and that's what we did. That's why I was in Port Macquarie. It was definitely not a lifestyle choice. It was early 20s. I wanted to be in Sydney with mates and going out and all that stuff, and to the point where we drove that Port Macquarie drive at least 30 times a year. Right. And that I dreaded the Sunday afternoon because I knew I had a 4.5 hour, 5 hour drive ahead of us, and that it got longer the more you did it. Like that was the longest drive. Like it was horrible, but it was for the greater good. So a lot of people just don't make those little sacrifices. They want to do jobs they love. Sometimes just do the ones that pay a bit extra. Like there's a lot of fly in, fly out workers who get this. They do it. They're going to just do this horrible, rotation system for a few years. But the result is they're going to have some money that they can then invest. And once you do that, then you can go back towards your lifestyle because you'd rather have options in your 50s to then step back and not be hamstrung to a job just because you've done some hard yards in the early years. So, because the compounding time, like you mentioned, $1,500 a week, get the house early on. Time is literally the key. So, sacrifice early, it pays off later. That's basic but harder to do in principle.
When you planned out your journey, you talked about it a lot. And again, no ego when you talk about this because you don't strike me as that type of guy. did you always think you'd end up here? Like, was this always like, it's like someone that goes, I'm going to get fit and nothing's going to get in their way. For example, I'm going to do an Ironman under this type of time frame. So this result that you've got, it doesn't surprise you that you've got here?
No. Like from 25, I thought I was going to be here.
Yeah. Okay.
Yeah. So before then, no. But I always had like, I wanted to be an airline pilot because I like traveling and
you watched Top Gun too many times.
Yeah, exactly. And I did the, I went to ADFO and started the training, and I failed the medical because I had some asthma as a kid. So I remember they put us in a salt tank and the lung capacity dropped 10% or something. So that one moment changed a lot because once you join the Air Force at the time, I think it was a 12-year commitment or something like that. But it gave you free training to then be an airline part because it costs $150K to get the hours up and stuff like that. But I was always like wanting to chase jobs that at least paid well because it gave you options to travel and do all that stuff and surf more and go to Europe more, all those things. So rather than just do a baseline accounting job, that was never for me. But when it became real was when we were in Port Macquarie and I was playing around with spreadsheets and seeing the returns I was getting. And this had about 3 or 4 years track record by then. And I just basically, assumed I'd get the same rate over like a 30-year journey. And, you could see per age group, like you just mapped it out and put different variables in these randomly created spreadsheets. And I can see it was going one direction. I just had to keep doing what I was doing and it would have got there. It just happened probably 10 years earlier than I thought. So,
yeah, nice one.
But yeah, I always thought it was going to happen. I was very comfortable with numbers and large numbers as well. Like when I was taking debt out at younger years, like it was never a concern because I just knew the mechanics behind it. Like if you put an extra 2 zeros on the end of it, totally fine. I was very comfortable with that. It wasn't how much was owed to the bank. It was really about how much income is getting created, how big is this business or property portfolio becoming, and the scale is where you make the money in it.
Yeah, nice one. I guess the question behind that one is, as you're on the journey and you're trying to tell people, come with me, they don't believe you. But when you've got here, either like, I want what you've got now, Scott, and you're like, I've been trying to tell you this whole time, but you want to only see the finished product. You don't want to see someone on the journey. Did you have any of that? Did you encounter any of that yourself?
Look, mostly just by randoms calling you out on the internet, like after a big article, and it was only the first article that was really bad because it was a big clickbait, like 0 to 12 mil or something in 5 years. I don't know. It was one of those type of very like residential clickbait type. And everyone just goes, oh, you got money from your parents, and like, which we didn't. Like we started, it took us 5 years to save a 60K deposit, and I've worked at McDonald's. I was a field hand surveyor. I'd worked 5 years in a pub, like did all, all that stuff to get that money.
Yeah.
But they just think that you got a free ride. So, it was like, I think it's the same metrics apply, but, people are pretty respectful. I think there's so much education out there now that those who want to believe it, like, they get it. I tell people that you don't just jump straight into commercial now. You still start and do all the same stuff we did. Cut your teeth first, learn the ropes on residential. There's less downside. It's less cash flow. There's potentially less upside, but the downside is the key part. Because if you have a bad day in commercial, you won't invest again. It's like I've had bad days in stock markets, and I just think I just don't see the value in it now. It's not worth it. Like I'm not going to put large sums of money on a company that I don't control, because
100%.
What variables have they used to justify their business multiple valuation? Like I feel like I've got an inside trading advantage with property. Why would I then not have an inside legal advantage in shares? So, and it's because I've lost money in shares. So you can lose money in property.
Yeah.
And you start where you're less likely to lose, and that's just classic freestanding houses, and then move up towards the risk profile as you move on. So
I want to talk about that, unpack that journey, because I mean, you're pro commercial, and everyone's like, and I see them, you may cringe sometimes when you read some of these Facebook groups. I occasionally jump on there as like, call it market research, and like, right, I'm going to go buy my first property is commercial. are you looking at that just going, hey, like you said, build a solid base and a foundation of some quality bread and butter investment properties that will give you some cash flow and some equity to then move into, would you call commercial a bit more for a mature or astute investor?
Yeah, and it depends on your wealth position. So I've got a lot of first-time clients who go straight into commercial.
Right.
Straight into a $10 million commercial too. And they're generally like a business owner. So, they might have an IT business and they've just sold a big portion of it and they've got all this cash in a bank. I don't see the value in them going, I'm going to buy 750 grand houses and because they've already got the wealth. So their job's now to protect the wealth and kind of like create a new business because they've already made it essentially. So go buy a shopping center, might have 10 tenants, supermarkets, medical center. You can go straight to the trophy asset, which is that intergenerational wealth. Like you've got a freehold property that's one of the best properties in that town. That's when you go straight into commercial, even if it's a $3 million one. Yes, it's fine. But if you're a mum and dad and you've squirreled away 500 grand and that's all you've got for 10 years, you don't go straight into commercial. Go buy 2 or 3 houses. And it depends on your age as well. If you're 65, like our oldest client's 87, there's no point him getting into residential because he just needs cash flow now. He'll enjoy it. Hopefully he lives to 100 plus. There's still a fair bit of time in the market, but what's the point of him buying a negatively geared or just evenly geared house with debt? Or even if it's with cash, what do you get 5% gross return? Take your outgoings, you're back to 3%. He's not going to live on that income. It's below inflation. So he'd be losing money again. And the capital growth, he's not there to sell it. And he doesn't want to refinance, probably won't be able to as well. So everyone's got a different story. But generally younger people leverage into residential property because, you'll get your 6-7% growth long term. And that's going to be a creator of a future deposit for a commercial asset. So if you've got 3 or 4 of those for 10 years, or 5 years, pull out all the refinance at once, and then you use that nice chunky deposit to go into a higher, better quality commercial property. And that's kind of how we help strategize with our clients.
That's a wrap for part 1 of our interview with Scott O'Neill. He's an absolute weapon when it comes to investing in commercial property and sharing his journey as well. We hope you like part 1. Stay tuned for part 2 of our interview with Scott coming up shortly.